The scene begins by questioning the conventional belief that governments control money. It challenges the audience to reconsider who truly dictates monetary policy. The setting is an indoor historical archive, suggesting a search for answers in the past. This implies a deeper investigation beyond surface-level assumptions. The narrative aims to uncover the real power dynamics behind financial systems. The script sets the stage for a potentially controversial or revelatory exploration. The Federal Reserve is presented as a significant institution. It is characterized by its considerable power within the economic system. The institution's operations are described as potentially opaque. This opacity raises concerns about its accountability. The Federal Reserve's structure and actions warrant careful scrutiny due to its potential impact. The scene is set in a historical archive, symbolizing the exploration of the Federal Reserve's origins. The setting highlights the historical context and significance of the Fed's establishment. The archive represents a deep dive into the foundational aspects of the American financial system. The location underscores the Fed's enduring influence on American finance. The scene is set indoors on Jekyll Island, Georgia, in 1910. A clandestine meeting is taking place. Bankers are present at the meeting. Politicians are also in attendance. Financiers are participating in the secret discussions. The meeting took place indoors on Jekyll Island, Georgia, in 1910. A key characteristic of the gathering was its high level of secrecy. There was a deliberate absence of press coverage to maintain confidentiality. The lack of official records and public input further emphasizes the clandestine nature of the event. The meeting's objective is to establish a central bank. The meeting takes place in Jekyll Island, Georgia, in 1910. The establishment of the central bank is to be conducted discreetly. The meeting's location and secretive nature suggest a clandestine approach. The aim is to create a central banking system while maintaining a low profile. The Federal Reserve Act was passed 3 years later. This act established the Federal Reserve System. The Federal Reserve serves as the central bank of the United States. It plays a key role in regulating the U.S. monetary and financial system. The establishment of the Federal Reserve Bank signifies a pivotal moment in American financial history. It represents the creation of a central banking institution. This institution was designed to provide stability and oversight to the nation's monetary system. The Federal Reserve plays a crucial role in influencing economic policy. It has a significant impact on the financial landscape of the United States. The Federal Reserve, the Fed, has several core functions within the U.S. economy. One key function is controlling interest rates to manage inflation and stimulate economic growth. The Fed also has the authority to print money, influencing the money supply. Another critical role is regulating banks to ensure financial stability and protect consumers. The Federal Reserve System exhibits characteristics of both public and private entities. This hybrid structure is a key aspect of its operational framework. The Fed's public nature is reflected in its role as a central bank. It is responsible for implementing monetary policy. The private aspect is seen in its ownership structure. Member banks hold stock in their regional Federal Reserve Bank. The Federal Reserve Board's appointment process is structured and defined. This process contrasts with the ownership structure of regional Federal Reserve banks. Regional banks operate with a degree of private ownership. The board's process aims to ensure public oversight and accountability. Appointment procedures are designed to maintain the board's independence. This structural difference highlights the balance between public and private elements within the Federal Reserve System. The Federal Reserve, Fed, operates with a level of confidentiality. This operational secrecy allows the Fed to influence economic activities. The Fed's actions can affect various aspects of the economy. The degree of secrecy is intended to maintain market stability. Financial decisions exert a direct influence on the mortgage market. These decisions can significantly affect employment rates across various sectors. Mortgage rates are closely tied to the stability of financial institutions. Employment opportunities fluctuate based on financial health. Collectively, these factors determine the overall financial stability of a region or nation. The scene shifts to Wall Street during the 2008 financial crisis. This period was marked by significant instability in the financial system. The crisis led to the Federal Reserve implementing a bailout of Wall Street. The bailout aimed to stabilize the financial system and prevent a complete collapse. In 2008, a large sum of taxpayer money was used to bail out failing financial institutions. The government intervened to prevent a complete collapse of the financial system. This intervention involved the injection of trillions of dollars into the financial sector. The goal was to stabilize the economy and prevent further damage. However, the bailout raised ethical questions about fairness and moral hazard. Critics argued that it rewarded irresponsible behavior and created a system where institutions were too big to fail. The scene is set in 2020, during the height of the pandemic. The Federal Reserve intervened by injecting liquidity into the markets. This action aimed to stabilize the financial system amidst economic uncertainty. Liquidity injections are a tool used to increase the availability of funds. The Fed's intervention was a response to the economic challenges posed by the pandemic. The Federal Reserve convened in its conference room in 2020. This occurred during a period of economic hardship for many individuals. Small businesses on Main Street were also struggling financially. The Federal Reserve's actions aimed to address these economic challenges. These actions had implications for both individuals and small businesses. Asset prices experienced a significant surge. This increase in asset values led to substantial financial gains. The primary beneficiaries of this surge were individuals holding significant assets. Wealthier individuals typically possess a larger share of assets. Therefore, the rise in asset prices disproportionately benefited the wealthy. This dynamic can exacerbate existing wealth inequalities. Average worker wages have experienced a period of stagnation. This stagnation means that wages have not significantly increased over time. Wage stagnation contributes to the widening gap between high and low-income earners. The lack of wage growth exacerbates existing economic inequalities. Economic inequality is intensified when wages fail to keep pace with economic growth. The Federal Reserve's actions have been characterized by a lack of significant accountability. This limited accountability highlights the considerable autonomy the Fed possesses. The institution operates with substantial independence in its decision-making processes. This independence allows the Fed to implement policies with minimal external oversight. The absence of stringent checks and balances raises concerns about potential overreach. The Fed's unchecked power has implications for financial stability and economic policy. Effective control of the money supply is presented as a key factor. This control directly influences the economic landscape. Managing the money supply can shape economic outcomes. Economic data visualization can help understand these effects. The Federal Reserve's balance sheet reflects its assets and liabilities. The balance sheet size indicates the scale of the Fed's monetary operations. A balance sheet of over $8 trillion demonstrates a substantial level of assets. This growth is often associated with quantitative easing or other interventions. Changes in the balance sheet can influence interest rates and economic activity. The Federal Reserve's actions can influence financial markets. These interventions can lead to market distortions. Such manipulations may create artificial market conditions. These conditions may not reflect true economic fundamentals. Asset prices may deviate from their intrinsic values. This can pose risks to investors and the overall economy. The Federal Reserve, Fed, can influence financial markets through its monetary policies. One potential consequence is the distortion of risk assessment among investors and financial institutions. This distortion can occur when the Fed's actions create an environment of artificially low interest rates. Lower rates may incentivize excessive risk-taking in search of higher returns. This behavior can lead to the misallocation of capital and the formation of asset bubbles. Ultimately, distorted risk assessment can contribute to financial instability and economic downturns. The Federal Reserve's policies can influence the distribution of wealth within an economy. These policies can lead to a redistribution of wealth among different segments of the population. The redistribution of wealth tends to flow upwards. This upward redistribution means that wealth concentrates towards the top. Inflation refers to the rate at which the general level of prices for goods and services is rising. A key consequence of inflation is the erosion of savings over time. As prices increase, the real value or purchasing power of money decreases. This means individuals can buy fewer goods and services with the same amount of money. Therefore, inflation directly diminishes the purchasing power of individuals and their accumulated savings. Debt can become a long-term recurring financial burden. This can lead to individuals being caught in cycles of debt. These cycles are characterized by continuous borrowing and repayment. This creates a state of ongoing financial obligation for the debtor. The Federal Reserve, the Fed, plays a crucial role in the U.S. economy. However, its operations and impact are often poorly understood by the general public. This lack of understanding can lead to misconceptions about the Fed's goals. It also affects public perception of the Fed's effectiveness in managing the economy. Increased public awareness of the Fed's functions is vital for informed economic discourse. Understanding the Fed's tools and objectives promotes better financial literacy. A lack of understanding is presented. This lack of understanding is portrayed as intentional. The intention behind this lack of understanding is to maintain control. This control is exerted by the Federal Reserve, the Fed. Therefore, the Fed's control is maintained through this intentional lack of understanding. The Federal Reserve operates as a central banking system. It is more than a typical bank. It embodies a significant power structure. The Federal Reserve influences monetary policy. It plays a key role in the economic stability of the nation. The origins of secrecy are often shrouded in mystery. Secrecy can foster distrust among individuals or groups. It also encourages speculation about the hidden information. These elements combine to create an environment of uncertainty. The Federal Reserve's intricate structure obscures its operations. This complexity makes the Fed difficult to understand for the general public. The lack of transparency shields the Fed from close scrutiny. Reduced scrutiny can limit public accountability and oversight. The Federal Reserve, the Fed, is often regarded with a level of inherent trust. This trust can lead to a lack of critical scrutiny regarding the Fed's policies and actions. Public opinion may not always fully examine the implications of the Fed's decisions. This uncritical acceptance can have implications for economic oversight. It is important to encourage informed public discourse about the Fed's role and impact. The script prompts viewers to consider the beneficiaries of Federal Reserve interest rate increases. Raising rates can influence various sectors of the economy differently. Understanding these impacts requires analyzing who gains and who loses. Higher rates can benefit lenders and those with savings accounts. Conversely, borrowers and businesses may face increased costs. The script encourages critical evaluation of the Fed's monetary policy decisions. The Federal Reserve, the Fed, plays a central role in shaping the current financial narrative. The script highlights the Fed as the originator of this narrative. This implies the Fed has significant influence over how financial events are understood. Understanding the Fed's role is crucial for interpreting the financial landscape. The Federal Reserve plays a crucial role in shaping the national economy. Its policies and actions have a wide-ranging impact on various sectors. These actions influence key economic indicators such as interest rates. The Fed's decisions also affect employment levels and inflation rates. Understanding the Fed's role is essential for comprehending its influence on individual lives.